Markets are off to a strong start in 2024, continuing the momentum from the October low. Let's take a look at the fundamentals and technicals to get a better sense of where the market may head this year. Fundamentally, there are a few things that can drive markets higher. Number one, we get rate cuts from the Fed. The Fed did indicate in their December meeting possible rate cuts for 2024. Now, I'm going to dive deeper into the Fed funds futures a little bit later in this video. Number two, earnings growth. If earnings are going up, stock prices will follow. I found this report from FactSet that shows after 3 consecutive quarters of negative earnings growth, we may be on the cusp of 2 consecutive quarters of earnings growth. Now, if earnings have indeed troughed and this trend continues, this could be better than actual rate cuts. Number three, inflation is on a downward trend. Now, while that last mile of getting inflation to the Fed's 2% target will be challenging, it appears overall we have slayed the inflation beast. Now, this is probably why the Fed signaled possible rate cuts. Now, as far as the bear case, it's pretty much the complete opposite. The Fed raises rates, we continue to get negative earnings growth, we get a spike in unemployment, and inflation starts to tick up. Currently, the market is very strong and we are consolidating right around the all-time high of 480 on the SPY. Now, we also just pulled back from an overbought reading on the RSI. We are trading above all the major moving averages and they are sloping upwards. A strong bull trend is in place. You can see that with the higher lows, and we have also consistently taken out all of these previous swing highs, all very bullish activity. Now, I think earnings from the Mag 7 will have a big impact on whether or not we can break through this all-time high and keep running. Now, I don't see any topping formations or bearish engulfing candles as I saw back in the summer of 2023 when we were topping out. You can see that head and shoulders right there. You can see that bearish engulfing candle right there. These can always develop as time passes, but I don't see anything right now. So both the dollar and rates look like they want to continue to trend lower. Additionally, crude has been trading lower, and that is generally great for the consumer. Now, jumping onto the weekly chart, I do see a cup and handle pattern forming. This is generally considered a bullish continuation pattern. So one of my biggest concerns is that we are getting a bit extended over the major moving averages. Now, back in July, we were up as much as 11.5% above the 200-day moving average before we printed that bearish engulfing candle and the markets began to correct. So currently, we are 9% above the 200-day moving average. So if history were to repeat itself, and let's be generous and say that we can get as high as 13% above the 200-day moving average like we did in September of 2020 before correcting, that would put the SPY at around 5,000 before we would get a correction. Now, markets are always attracted to large round numbers, both technically and psychologically, so I really feel this could be a likely scenario before we get that correction. Now, we do have a few unfilled gaps on the chart at 440, 430, and 423. Now, the VIX is getting crushed and trading close to 12. The last time we saw a VIX this low was right around the start of 2020, and we all know what happened soon after. So currently we have an IV on the SPY of 13%, which means volatility has been higher than it currently is 87% of the time. Just take a look at the skew to the call side. I can buy at the money puts going out to June for $12.81. And I mean, just look at how much they cost on the call side. I think this might be a good time to think about buying some insurance. According to the Fed funds futures, the market consensus is we will get as many as 6 rate cuts this year, with the first rate cut at the March meeting. Now, if inflation comes in hot or unemployment spikes, the market will not get these cuts and then likely trade lower, causing a correction. At this point, the narrative will switch to we're going to a recession, the Fed isn't done, we're going to get a spike in volatility, dump stocks, buy bonds, and that'll probably be your cue to really buy the market. So overall, markets are in a strong place technically and fundamentally. We are expecting rate cuts from the Fed this year, earnings appear to have troughed, and inflation is trending lower. Now, markets are starting to feel a bit extended and the VIX is dangerously low. Any hiccups in earnings or a slightly more hawkish Fed could upset the markets, leading to a correction. Now, I continue to stay long the S&P and continue to dollar cost average into the market. Let me know in the comments where you think the market is headed this year and if you think the Fed has finally become our friend.